Hi, it's Dre Griggs with Obsidian Wisdom. Today we answer the question, what is the average 401k balance by age? When you're planning to retire, whatever age that is, you really want to make sure that you have enough money to stay retired. There's actually a bunch of numbers that go around, and the most recent one I've saw is based on the average income of an American, you want to have about $1.7 million in retirement so that you can live off of a certain percentage, a reasonable percentage that you can expect to get based on not worried about losing all of your money. Sure, we can try to invest and get 10, 15, 20, 30% in the stock market, but when you're in retirement or very close to retirement, you actually have to shift to what we call capital preservation. It's just a very fancy way of saying, I can't afford to lose my money right now. The stock market, yes, it goes up and down. Yes, it traditionally goes up over a long period of time, but if you are about to retire, you don't have that long period of time to wait. If you end up losing 20%, 30%, 50% of your portfolio a year or two before retirement, you may not be able to retire. Or if you do retire, it will cut off 10, 15 years of income that you would have been able to get from your retirement, but you no longer can. That is why we normally shift to capital preservation. Just want to make sure my money is there. Can I get a 5% return consistently? Can I then live off of that 5%? So I'm basically living off the interest and I never touch the principal. Ideally, that's how we're all set up because we don't want to run out of money while we're in retirement because we don't want to have to go get a job. Even though the majority of Americans have already accepted the fact that they feel like retirement for them means they're going to have to work somewhere and in some way. Now, while I don't have an issue either way, if you want to work, God bless you, work. If you want to go out and you have always this dream and you just want to work for fulfillment and you enjoy doing a certain thing, then I would say go for it. But if you have to work because you're worried about Social Security not being enough for you to live off of, which it's pretty difficult to live only on Social Security, but if you are able to have the money, then you're going to want to listen closely because this is for you. This information is actually being pulled by Vanguard. They survey their investment portfolios and they see how much money people have in their 401k. And while it's not exact, that's usually the account that most people do have. They have an employer match. And you also have the law passed in 2006 where people are automatically enrolled in their 401k. So most people have that type of an account. When you're younger than 25 years old, you have on average $6,200 set aside in your 401k, and then you have a median of about $1,700. The reason I'm giving you both is you already know the average can be skewed significantly. If you have a few people who have $1 million in their 401k or tens of millions of dollars in the 401k, that could bring the average up. But the median, that's the number in the middle, right? Like the median of the road. If I put it in order from least to greatest and the number in the middle, well, that would be $1,700, which is a pretty significant difference from $6,200. So while you have on average $6,200, you actually have about $1,700 as the median. When you're looking at how much of the income you want to have, like a good goalpost, the goal when most of us retire is to have about 10 times our income. If you have 10 times your income, then you usually feel pretty good about your ability to be able to live in retirement. And for most of us, that would include inflation, where it goes up about 3% each year. So that number is going to actually be a lot higher. So you wouldn't say, well, I make $100,000 today. So if I need 10 times that income in 20 years, and that means I need $1 million. While that is 10 times of $100,000, it doesn't take into account when you're retiring. In a general rule of inflation, a great place to just start is every 17 and a half years, you need twice the income to be able to live the exact same lifestyle. So if you're going to retire in 20 years, then you should say, I need $200,000 for me to be able to retire. And then 10 times that amount would be $2 million. If you're going to retire in 10 years, then maybe you would just increase it by half. So I have $100,000 today. Well, I would only need $150,000 then. And then 10 times that would be $1.5 million. That's what I would need. Realistically, it's just a great place to just simply say, what am I trying to accomplish? And these are good numbers just to get us started. I think the number says on average, people think they need about 1.7 million in retirement. And I think that's a really good number. For most people, I say, let's shoot to be a millionaire. It has a nice ring to it. It sounds really nice. So I think it's just a good place to start. And then we can go from there, whether it's Social Security or your pensions, or you're going to sell a bunch of stuff and start a business in retirement, however you want to generate your income. I just think, why don't we just become a millionaire? Not only because of the money that you have and it has a nice ring and it sounds pretty cool, but it really is what you had to do to achieve that. who you had to become. The mindset shift that you took over those years to become a millionaire is what we're really looking at celebrating. So back to the numbers. So under 25, you would need about $6,200 on average. That's what the person has. Most of the people, whatever you have there is a pretty good number. When you get to 30, we generally say, you're going to have one times your income. So if you make $100,000, then you want to have $100,000 set aside in your investment fund by the time you're 30 years old. The average person in their 26 to 34 range, they have about $37,000. And then they have a median. Now, again, that's the number in the middle. If you line them up from smallest to largest, they have $14,000. From 35 to 44, it's $97,000. And then you have a median of $36,000. From 45 to 54, it's $180,000, where the median again is $61,000. And from 55 to 64, you have on average $256,000 in your 401k with a median of 89,700. So basically about $90,000 is what people have set aside as the median. And then from 65 and older, they have about $280,000 in their 401k. And then that's about $88,000 as far as the median. Again, the median is the number in the middle, like the median of a road when you're driving. For the average person to have 10 times their income set aside for retirement, you would normally say, by the time I'm in my 30s, I want to have one times my income. So again, I like the math to be simple. So if you make $100,000 in a year, then you would want to have $100,000 in your investment accounts, whether that's your 401k, your IRA, your Roth, your brokerage accounts, and real estate, however you want to shuffle up the money, you want to have $100,000 set aside. And then by the time you're in your 40s, you will want to have three times your income. So we went from one times my income to three times my income. And so if we had $100,000, you would ideally want to be somewhere close to $300,000. Again, keeping in mind things like inflation. But if you're investing the money, then you at least have a chance to overcome that amount because it's baked into the stock market cake. If every time I invest in a stock gets reevaluated and the company is worth more, well, it's based off of what people are paying in that company, the revenue is generating. Well, the revenue and hopefully the price that that company is charging is already taking inflation into consideration. So if I had a movie ticket, while you may say, well, okay, Dre, 20 years ago, I can get a movie for $5 and now it's $15. Well, that is a part of that company's revenue, which we then use to determine the value of the company. And so you can see why it's already baked into the cake. And it's also something, just as a side note, where you do want to make sure you're keeping track of how much of the revenue and increasing your stock's value is inflation versus how much of the revenue and the increase in stock's value is actually being driven by the value that the company is providing the public. You don't want your returns just to be inflation. But anyway, so if you're in your 40s, you want to have three times your income. By the time you're in your 50s, you want to be around 6, 7 times your income. And then that sets you up to being, when you retire in your 60s, you want to be at 10 times your income. If your plan is to retire at a younger age, then you need to get to that 10 times your income quicker. And whether that is you have a side hustle, whether that is you invest a higher percentage of your money on a more regular, consistent basis, whether it is that you have the income that you need, are going to have a significant shift in how much you spend. So you may say, you know what, Dre, I do live off $100,000 a year currently, but when I retire, I'm going to comfortably live off of $30,000 a year. Then you may just be able to live off of Social Security. You may not have to worry about the money as much. Or some of you are going to say, you know what, Dre, I have a pension. I work for the government. I'm in the military, or whatever your pension fund comes from. And as a result, my pension is already, if I work 15 years, they're going to give me 70% of my salary. So I'm already set on that. I'm going to get that amount every single year. Again, then that means you don't have to figure that amount out. For most people, I say the pension, you set that aside as my needs. So anything that you have to pay to keep the lights on, food, groceries, gas, your housing, things like that, you'd say, okay, my pension is going to cover that. So I have all my needs done. And then any of the investments that you do, those could be your wants. You may want to travel. You may want to provide for your kids or grandkids. You may want to do all sorts of amazing things. Well, you can then invest for your wants. And you can do all of those amazing things if we plan for it. So if you're someone who plans on retiring earlier than 60 and you want to get your financial freedom number, then you could say, all right, what would I need to get to 10 times my income now? How would I go about getting that number? And then you invest that. And for some people, if you have kids, and a lot of the families that I deal with, it becomes difficult to do it just off of your income. more times than not, you're going to need to have some sort of a business or start investing in real estate. You have to generate another form of income. And I do talk about the 7 forms of income that the IRS recognizes, that some of them are passive, some of them is like dividends in the stock market, some of them is real estate and the rental income, patents and inventions. You have a business, the salary that most of us have. You can have interest that you get from your bonds and things in your like money market accounts where they give you a set amount of money each year. And so you have these 7 forms of income, and then you can say, all right, well, I know I need to get at least 3 of these because, as I've told you, 65% of self made millionaires have at least 3 forms of income, which means for you ultimately to retire and achieve financial freedom quicker, you have to increase the amount of income that you have, the forms of income that you have. You only have so many hours. So it's not about you working longer, or it's not even always about you making more from you physically working. It becomes a mental shift where I have to get my money to work for me, which step number one means I have to pay myself. Step number two means I can't be paying everybody else based on debt. Like I can't invest my money in bad investments. And sometimes a bad investment is the car because you know the value decreases. Sometimes a bad investment could be the house that you purchase because it pushes back your financial freedom. You have money that now has to be allocated towards something. And I was just reading a study actually just the other day that talked about how much people underestimate how expensive it is to own a house, where it's about $17,000 on average is what they spend in addition to what they already knew they had to spend to have the house. And you and I know that could be anything from your AC to your lights to flooding and plumbing to landscaping or HOA fees. I mean, there's just a lot of different fees that we have to deal with that maybe we weren't prepared for. But for you, if you want to achieve your financial freedom number quickly and efficiently, then you have to limit how much your money goes out to other expenses. I'm not telling you to live in austerity on like 20% of your income, but I am saying you should be mindful about where your money is going. You want to achieve happiness not only today in the short term, but over the long term. And long term happiness is built not as much on the money, but it's what we're doing with our time, how you allocate your time. If you have your time going towards a job that feels like a dead end, then you're less happy than someone who their time goes towards activities with their family and their friends. If you have to work in something that's counter to some of your core values, or maybe you felt like you had to sacrifice or sell a piece of yourself to accomplish a certain task, then you would feel less happy than someone who doesn't have to compromise on their core values, where they're able to owe no man nothing but love. And so you just want to be able to keep this in mind. But ultimately, when it comes to your 401k, you want to get to a place where you have about 10 times your income. That is a great place to start. And you want to have that amount by the date you plan on retiring. I just think it's a great place to start. It's not a golden rule where it's always the case, but I do find that it increases the likelihood of when you retire, you stay retired. Hey, thanks for watching this video. If you found value, I simply ask for you to like and subscribe so you can continue getting financial advice on how to stop worrying about money and create wonderful experiences with your family.